Good afternoon, everybody, and welcome to Part 3 of Zeifmans' Non-Resident Digital Series, the Cross-Border Edition, Leveraging Strategy and Evolution, which will be presented today by our U.S. tax team here at Zeifmans. My name is Kelly Bird. I am the Marketing Manager here. And before we begin, I would just like to go over a few housekeeping details with all of you. If you have any questions throughout the presentation, feel free to ask them in the participant feedback section, which is a chat box located on the lower left-hand corner of your screen. We will try to answer as many questions as we can at the end of the presentation. If we don't, someone will follow up with you directly afterwards, and we look forward to connecting. In addition, we will also be recording today's presentation, which we'll be sending to you tomorrow, along with the recorded interviews from this morning on our Instagram channel. And with that, let me tell you a little bit about Zeifmans. We are a full-service tax and accounting consulting firm based in Toronto, Canada. We are actually ranked as one of the top 20 firms in all of Canada by revenue. Our services are very vast, which include business advisory, valuation, corporate finance, transaction services, corporate turnaround and insolvency, and estate and succession planning. And most importantly, for today's purposes, U.S. tax. We've been in business for 60 plus years, developing innovative financial tax and accounting solutions driven by creative insight to help guide entrepreneurs. We may have a total of 18 partners, 150 staff that are available to you at any time, whenever you need them. We are also a member of NEXIA International, which is one of the top 10 global networks of accounting and consulting firms around the world. And what does this mean for you? Let's say you want to expand into Germany, or maybe it's Hong Kong. Our team here at Zeifmans can help you do that through our affiliation with NEXIA International. They've been around for 25 plus years, and they meet and maintain high quality control standards. So as we move on to today's presentation, I would like to quickly introduce you to each of our presenters, starting with Chaim Rosner, who's the U.S. Tax Manager here at Zeifmans. Chaim has joined Zeifmans in 2016. He has a broad range of U.S. tax experience, advising clients in a variety of industries. Chaim has experience with U.S. and Canadian cross-border taxation strategies and U.S. federal and state income tax compliance for corporations. Next, we have Brian Cohen, who is also a U.S. Tax Manager here at Zeifmans. Brian joined Zeifmans in 2017 and has over 8 years of diverse experience. His expertise is in advising Canadian-based investors and businesses on expanding into the U.S. and helping dual citizens meet their U.S. and Canadian compliance obligations. And finally, we have Kobi Rosen, who is also a U.S. Tax Manager here at Zeifmans. He's been with our team since 2013 and has over 10 years of experience of practicing and working in tax and accounting public practice. Kobi's expertise lies in U.S. and Canadian cross-border taxation strategies and compliance. And with that, I'm going to pass the baton on to Chaim, who will be walking you through what we'll be covering in today's presentation. Chaim?
Thanks, Kelly. I'd like to thank all the viewers and listeners for joining in, and again reminding you to ask any questions throughout the webinar, and we'll try to get to them at the end of the webinar. For today's agenda, we will be dealing with a couple of hot topics, which include expanding into the U.S. in a digital economy, the federal and state income tax and sales tax implications, and how the Wayfair ruling affected the digital economy. Then we'll move on to another hot topic, which affects a lot of our clients, and that is investing in real estate in the U.S. as a non-resident. And finally, we'll move on to the Biden tax plan and potential changes to corporate and personal income taxes and how that might affect you as a business, and estate and gift tax, which can affect non-residents, especially those investing in U.S. real property. And then we'll close with legislative hurdles and predictions. So to start things off, even prior to COVID-19, business exposure to cross-border taxation of digital goods and services has vastly increased. So if you're ready to expand your digital operations into the U.S., here are some things to consider. Traditionally, some of the ways that businesses can create a U.S. permanent establishment, which in the tax community we like to call a PE for short, is by having a physical office or a fixed place of business in the U.S. or concluding contracts with customers in the U.S., or even having employees conduct business in the U.S. for extended periods of time. A permanent establishment in the U.S. would subject the foreign business to U.S. tax on its U.S.-sourced income, which is effectively connected income from a U.S. trade or business. So what happens if a business doesn't have a PE in the U.S., but has U.S.-sourced income? Are there any filing requirements or tax obligations? So from a federal perspective, although there's no PE, the business is still required to file a treaty-based return, which basically states, I have X amount of income, but I'm not subject to U.S. tax because as a resident of Canada, or whichever foreign jurisdiction you are, I'm already taxed on this income. So why is it important to file a treaty return and file it on time? Because there's a potential $10,000 penalty if the treaty disclosure is omitted or filed late. Now let's move over to the digital economy, where foreign businesses can now utilize the markets without the physical footprint that was historically required. Do they fit under this category of not having a PE in the U.S. and therefore are not subject to tax? So the evolution of business in the digital world poses jurisdictional challenges to taxing authorities, such as the IRS, in ensuring that non-residents are subject to tax on income earned within their jurisdiction. The U.S. and other jurisdictions have taken these steps to adapt the definition of what a PE is to a digitized economy, and we may see some changes in the near future. So that's definitely something to look out for. States, by the way, are already miles ahead of the federal government, which we'll get to shortly. Now, prior to doing business in the U.S., or even Canada for that matter, you should reach out to your Zeifmans advisor to discuss the best structure that fits your business needs. The proper structure will hinge on your specific business and may also be impacted on the upcoming Biden tax changes, which Kobi will talk about later on in this presentation. Just to give you a basic idea of the common types of structures that we deal with day to day with cross-border taxation. Some businesses like to operate their Canadian corporation through a U.S. branch, which an advantage to that is that you don't have to form a new entity because you basically use your Canadian entity and just form a U.S. branch part of your operations. However, the disadvantages of operating as a U.S. branch is that there's less liability protection, there's potential for state tax on your worldwide income, not just your U.S. source income, and a potential trigger of branch profit tax, which is a second layer of tax on direct U.S. investments. Now, there may be treaty protection to mitigate some or all of the branch profit tax, but that's beyond the scope of this webinar. Another option is to organize as a U.S. corporation. This option is very common and there's limited liability. We generally like to use Delaware as the incorporating state, as there should be no income tax obligations if there are no activities in Delaware or if your domicile place of business is elsewhere. However, you're still required to file an annual franchise report, but the cost and reporting involved are very minimal. Now, another option is an LLC. In the U.S., if there are multiple owners, its default is to be treated as a flow-through, kind of like a partnership. But if it's owned by a single entity or single member, it would be considered a disregarded entity, which means that for tax purposes, it's not considered as a separate entity from its owner. However, this causes a problem because in Canada, it's treated as a corporation. And this is what's called a hybrid entity. We typically don't advise this type of entity when dealing with cross-border operations, as there is no treaty protection unless you check the box to be treated as a corporation, which Brian will get to later in our presentation. Then there's another form of organization structure, which you can form a partnership, which is a flow-through. When dealing with non-resident partners, the compliance aspect can get pretty complex with all of the withholding requirements involved. Now, as said before, foreign corporations with a permanent establishment and non-resident individuals with effectively connected income with a U.S. trade or business are taxed at 21% at the corporate level and graduated rates for individuals with the top margin currently at 37%. Now, this might all change with the Biden tax plan and may affect your overall approach to doing business in the U.S., which Kobi will touch upon these potential changes. While we're on the topic of taxation, U.S. fixed determinable annual or periodic payments, now try saying that 10 times fast, in short it's called FIRPTA or passive income, includes interest and royalties, and has a 30% withholding rate, which may be reduced or eliminated via the treaty. And if you'd like to learn more on this topic, please feel free to contact your Zeifman advisor, as this is beyond the scope of this webinar. There are two major taxes that are levied by the state on businesses and consumers. There's the state income tax, which is a tax you pay on your total net income. And then there's sales tax, which is basically a consumption tax and is a percentage amount that your customers have to pay when they purchase certain items. So the question is, does the treaty protect a foreign business from state income tax that does not have a permanent establishment in the U.S., such as something like an e-commerce business? The answer to that is most states do not recognize the treaty, which means that there could be state filing requirements even if the business does not have a permanent establishment in the U.S. So states using a different terminology than federal's interpretation of a PE, from a state tax perspective, the term nexus is used to describe a situation where a business is subject to state income tax or sales tax due to the connection that the business has formed with the state. Now, common state income tax exposure includes a physical presence in a state, which generally speaking means employing a worker in the state, or owning or leasing or even renting equipment or property within a state, or even storing inventory. Now, other state income tax exposures that can create nexus, which are more relevant to the digital economy, is economic nexus. Now, economic nexus has been around for state income tax purposes for a while now. However, the Wayfair ruling, which we'll get to in a minute, not only had a major impact on sales tax, but it paved the way for more states to migrate and give clearer guidance as to what creates economic nexus from a state income tax level. Although you may not have a physical presence, many states use the following factor-based thresholds to determine nexus. A lot of states use the $50,000 as a property and payroll threshold, while sales at $500,000 or 25% of your total property, payroll, or sales. Just to point out, there are some states which have lower threshold numbers. For example, $100,000 of sales in New Jersey will create nexus, while other states like California and New York have higher thresholds of around $600,000 and $1 million respectively. Now, do you need to collect sales tax for online sales of digital goods? So for many years, states recognize sales tax nexus mostly as a physical presence, basically like having a warm body in the state. South Dakota challenged this and passed a law moving to an economic-based approach of either $100,000 of sales into South Dakota or 200 transactions. And many states followed suit. Does that mean the physical presence is dead for sales tax? The answer is no. Economic presence only enters the analysis when the vendor has no physical presence in that state. So what does that mean for the taxability of digital goods and services, such as software as a service, cloud computing, and digital products? When you're selling an item or service, you have to answer at least two fundamental questions. What is the item for tax purposes? And where are you sourcing the sales to? In other words, which tax jurisdiction are you being taxed? For example, if I go to the store and buy a book, most states say that this is a tangible personal property. It's a physical item. So where do I source it? Well, if I buy it from a local bookstore, I source it right there, right where I purchased it from. Now for digital products, let's look at the same example of the book, but instead it's an e-book, where I downloaded that same digital book to my computer. What is it? And where should I source the sale to? A lot of states are taking the stance where they're trying to treat the digital downloads in a similar way to how they treat a physical book. It's something like tangible property. And they're going to tax it that way and tax it where you are, your location, your billing address, where you were when the sale took place. What about a streaming service or software as a service? So this is where it gets more complex. You need to take a deep dive into the business operations and determine what the revenue stream is. Where is the service performed? Is it in multiple locations? Where is the customer located? Is the service part of a bundled transaction? If you're streaming, where's the license utilized? Does the customer have the right to sub-license? There are lots of examples of how this can get complicated. Whether you have a video game where you allow users to do in-app purchases or your business uses Amazon AWS for servers, all of these digital services and products are difficult to tax. The landscape is different. The law varies from one state to another. Whereas some states are adopting similar methods, such as the market-based sourcing, in which the service revenue is sourced to the state of which the benefit of the service is received and subsequently used. For example, a state like California, which uses the market-based sourcing, if you are providing a streaming service to a customer in California who ultimately delivers the stream to a customer in a third state, in certain instances, that revenue may in fact be sourced to that third state. And that's why it's important when you're expanding your business to be extra vigilant and to find out exactly what your tax liabilities are and to get the necessary advice by contacting your Zeifmans advisor. Now that we've delved into the tax implications at the digital level, I'd like to hand it over to Brian, who will discuss another hot topic, which is the business expansion into the U.S. via the real estate industry.
Thank you very much, Chaim. Chaim spoke about engaging in e-commerce in the U.S. Another very common activity in the U.S., especially by Canadians, is investing in U.S. real estate. That's what I want to cover now. What are the broad issues that you need to be aware of? First, let's talk about why Canadian investors might want to invest in the U.S. Well, they might have a view that U.S. real estate offers higher returns in comparison with Canadian real estate. It also offers diversification opportunity with the different locations, and there might be greater access to opportunities. As Chaim touched on, there's this concept of permanent establishment. If you're Canadian and you do business in the U.S. under a permanent establishment, you have U.S. tax obligations. Perhaps the quintessential permanent establishment is real estate in the U.S. It's actually a physical location you're operating and earning profit from. Therefore, you need to pay tax on all your real estate income. That includes your income year to year, real estate or rental income or loss, and also any capital gains you might realize upon final disposition of your property. Generally speaking, you're eligible for a foreign tax credit in Canada, and this will mitigate any double taxation. Additionally, as a non-resident, you especially have to be aware of the fact that any income you earn is subject to withholdings. As a non-resident in the U.S., you're kind of off the IRS's radar. So they want to make sure that any tax you owe is ultimately paid to them. So they make sure that tax is withheld at source. When setting up your structure, here are the things you want to consider. You want to consider the type of ultimate investor in your deal. Are they individuals, or are they investing through their own personal holding corporations? Are they strictly Canadian citizens, or are they U.S. citizens or even dual citizens? You also want to consider what your investment approach is. Are you intending to hold property indefinitely, where you're going to be recognizing rental income over several years? Or is your intention more short-term, where you're going to hold property for a few years and then intend to flip it at a capital gain? So this character of income will greatly impact which optimal structure is best for you. I want to talk about the different structure options out there. I don't want to cover any one in too much detail, except for the last one. You could hold property individually, that is, without any entity in place, or you can hold it through a flow-through entity. This would be either through a Canadian partnership, or you can establish a U.S. partnership and hold it that way. You can also hold it through a Canadian corporation or establish a U.S. corporation. There's also the U.S. Limited Liability Company, or LLC. Chaim mentioned that option a few moments ago, but this option is generally not recommended for U.S. real estate. Finally, we have the check-the-box entity election, and this is what I want to cover in just a little bit more detail. So here's what the structure looks like. Let's say you have several Canadian investors that would like to invest in U.S. real estate. those investors would invest in the Canadian partnership that's formed for this purpose. Now, this Canadian partnership would kind of hop across the border and set up a real estate operation there. So the Canadian partnership is, in effect, doing business in the U.S. The question is, how is this Canadian partnership going to be taxed in the U.S.? Well, by default, it's taxed, well, as a partnership, much like it's taxed in Canada. However, there is an election available called the check-the-box entity election, whereby this Canadian partnership can elect to be taxed as a corporation with respect to their U.S. operation. So they're a Canadian partnership for Canadian purposes, but under this election, they're a U.S. corporation for U.S. purposes. Now, this entity, I guess call it, their U.S. entity, that would in turn hold any U.S. property that they're ultimately invested in, either through a U.S. partnership or directly. So to make this election, you have to file certain forms with the IRS. And that will allow your partnership to be taxed as a corporation. The election must be made carefully in a specific manner and within a certain time period. It is possible to make a late election in certain circumstances, but it's best to consider and execute this as early as possible. Some of the advantages of this structure are as follows. It works very well for individual investors in the Canadian partnership, so that's the ultimate investors, as the 21% U.S. corporate tax rate is very close to the Canadian individual tax rate on capital gains. Now, capital gains are often the biggest income event. So if you think about the operations of your real estate before it's disposed of, there are many tax expense opportunities available, especially depreciation. So at the end of every year, the taxable income might be very modest or even result in a loss. So the capital gains is really the biggest income event throughout the life of your U.S. real estate. Additionally, Canadian investors do not have to file a U.S. non-resident tax return every year. Now, this is very convenient, especially for smaller investors. The U.S. tax return preparation fees might greatly diminish the ultimate return on your investment. So, going deeper, what are the tax requirements? So, certain entity and individual investors, so corporate investors or individual investors, depending on the structure, need to file a non-resident tax return annually. Of course, if you make the check-the-box selection, you don't have to do this. That's why that's convenient. On this return, you're going to report any rental or income or loss, if applicable, and of course, the capital gain upon disposition of the property. As mentioned previously, there's a foreign tax credit available to mitigate any double taxation. I've spoken really only about the federal tax implications, but there are also state tax considerations. These are beyond the scope of this webinar today, but certainly you can contact us for more details. Additionally, as mentioned before, non-resident investors are subject to a withholding regime. This is known as Foreign Investment in Real Property Tax Act, aka FIRPTA. When does FIRPTA apply? Well, it can apply in a few situations, but what we're going to focus on today is when you dispose of U.S. real property, which is really real estate, as a U.S. non-resident. And it applies to both individual and corporate owners. And it applies whether you've owned the property for personal use or business use. So, for example, if you're a snowbird, you go to Florida for a few months out of the year and you own property there, well, you might not be renting it out, but ultimately when you go to dispose of it, you'll still be subject to this withholding regime. So you definitely need to be aware of this. So how does it work? Well, the buyer must withhold 15% of gross proceeds upon purchase and remit to the IRS. So the buyer or the buyer's lawyer should be doing their due diligence to investigate whether you as a seller are a U.S. non-resident. And if so, they have to have the proper withholdings in place. And again, this withholding can be used as a credit on your non-resident tax return. Well, there are certain problems with this, and therefore this withholding might not be desirable. Firstly, this withholding can often be a severe estimation of ultimate taxes owing. So for example, if you have a pretty high cost basis and your depreciation of the property isn't significant, that 15% withholding on gross proceeds might be way more than your ultimate taxes owing. Additionally, you might have other capital losses that are sourced to the U.S. that can offset this gain. So again, the ultimate taxes owing might be significantly less than what was withheld. Additionally, the refund of excess withholding may be delayed. So of course, to get the refund of excess withholding, you have to file a U.S. non-resident tax return. And the earliest point you can file this is in the subsequent tax year. So for example, just to take the worst case scenario, if a non-resident of the U.S. sells property on, say, January 2nd, 2021, the beginning of the tax year, he would have to wait until early 2022 to file a non-resident tax return to recover excess withholding. So he'd have to wait a full year just to even file the return. And from there, he'd have to wait for a refund from the IRS. And in today's environment, given the COVID pandemic, the IRS is significantly backlogged. So it could take quite a while for this refund to come. Fortunately, there are some workarounds to this specific withholding regime. A non-resident investor can apply for what's known as a withholding certificate to reduce or eliminate withholding. This entails providing a calculation of the estimated gain from sale to the IRS, and the IRS will ultimately permit a withholding or perhaps zero withholdings that are more in line with the ultimate taxes owing. So if this is in place, your ultimate refund with your tax return will be none or minimal. And with this application, you have to include relevant documentation to support your estimated gain calculation, which otherwise wouldn't be required to be included with the tax return. But you have to be aware that there are timing issues with this application for a withholding certificate. It actually needs to be submitted by the time your sale closes. So terms and documentation need to be finalized. So in some cases, there's really only a small sliver of time available to get your ducks in order and submit this application. So definitely contact your advisor ahead of time to give them the heads up that this might be something you're interested in. So here are my key takeaways regarding investing in U.S. real estate. Make sure all relevant elections are filed on time, such as the check-the-box election to be treated as for a Canadian partnership to be treated as a corporation that I mentioned earlier. And if there's any withholding of the source, you can't just eat it and not file a return. You have to file a tax return. You know, you'd want to claim your refund, but you definitely need to file one in order to claim foreign tax credits on the Canadian side with the CRA. And most critically, speak to your Zeifmans advisor really as soon as you begin contemplating investing in U.S. real estate, so you can be sure the right structures are in place. Now I'm going to turn it over to my good colleague, Kobi Rosen, who will be discussing possible upcoming changes to U.S. tax laws.
Thank you very much, Brian. We'll now be turning our attention to the topic of potential changes to U.S. tax under a Joe Biden administration. This topic is important to be aware of because whether you're already doing business in the U.S. or if you're moving your business to or investing in the U.S. in the future, you'll want to make sure that your business operations are running smoothly. Since any changes to the U.S. tax landscape will affect your bottom line, it's important to make sure you have a plan in place in case these changes do take effect. So let's start by looking at potential changes to corporate taxes. In 2017, the U.S. federal corporate tax rate was reduced from a graduated rate of up to 35% down to a fixed rate of 21%. The Biden administration is now proposing to increase the corporate federal tax rate up to 28%. Now you might say that when comparing a 28% rate to the corporate tax rate in Ontario, which is currently 26.5%, well, that might not seem too high. But we also need to consider that there are state taxes depending on which state you might have nexus in. Assuming an average state tax rate of 6%, you're looking at a combined U.S. corporate tax rate of around 34%, which is significantly higher than the tax rates in Ontario. Additionally, the new administration is looking to re-implement a 15% minimum tax on earnings over $100 million. So what can be done about this? Well, if you do have operations in the U.S. and you have a parent company in Canada, you can consider transfer pricing maneuvers, which would be aimed at shifting profits from the higher taxed areas in the United States back to Canada. Another strategy to consider would be to accelerate income into earlier years, wherever possible, and to postpone expenses into later years when tax rates would become higher. Now let's turn our attention to the proposed individual income tax changes. First off, the new administration is proposing to increase the top tax rate from 37% to 39.6%, and this would affect single filers who earn over $400,000. They are also talking about increasing the Social Security tax for earnings over $400,000. Currently, Social Security taxes are paid on the first $137,000 of earned income. Under the proposed changes, there would be a break in this tax from between $137,000 and $400,000, but would be reintroduced for every dollar earned over $400,000. Of course, people working in Canada are not affected by these taxes since they are covered by what's called the Social Security Totalization Agreement, which basically means if you're paying CPP and EI, you don't need to pay U.S. Social Security taxes as well. So let's put all this into perspective. If you look at a high tax state like California, for a high-earning, self-employed individual, under these proposed changes, their marginal tax rate could be as high as 67%. That's more than 2/3 of their income, which just seems to be outrageously high, even to Canadian standards. So what can be done about this? Well, with the pandemic that's been going on, remote working has become increasingly more viable, and there's the potential to see high-income earners moving from places like California to states where they have low or no income taxes at all. As an example, I read last week that Tesla's Elon Musk would be moving out of California and into Texas, where they don't have any state taxes. Of course, he does have factories being built in Texas, but I'm sure he's not upset about the tax advantages of this move. I would not be surprised to see this trend increase over time and see other executives moving out of California as well. So let's look at problems that could arise which could specifically affect Canadians. The first thing is a proposal to increase the tax rates on long-term capital gains and dividends to a rate of 39.6% for individuals with income over $1 million. Currently, long-term capital gains and most dividends are taxed at a preferred tax rate of between 0 and 20% in the United States. As such, most Canadians have enough foreign tax credits from the taxes they pay in Canada to completely offset any U.S. taxes on this income. However, if the rates go up as proposed, there is the possibility of a foreign tax credit mismatch, which could cause high-income earners to have to pay tax on both sides of the border. One potential way to plan for this, at least in the short term, is to sell capital assets that were held more than 1 year right now in order to lock in the preferred tax rate. The next problem, which could potentially affect any U.S. citizen with a Canadian corporation, is the GILTI tax. GILTI, which stands for Global Intangible Low-Taxed Income, is a tax on the business income, as opposed to the investment income, of a corporation. It applies to people that own foreign corporations where the majority of the owners are U.S. people. Now, the way GILTI is calculated is complex, and if you want more information on this, please feel free to reach out to myself or your Zeifmans advisor. However, I will give you a high overview of how the proposed changes to GILTI could affect you. Based on the 2019 rate, so this is last year we're talking about, the GILTI tax amount that amounted to about 1% of a corporation's business income, where that corporation paid Canadian income taxes at the small business rate. Under the proposed changes, this tax could go up to 11.2% for corporations paying tax at the small business rate, or as high as 21% for corporations that pay no tax, which could be the case for corporations that have prior year losses. So what can people do to avoid paying the GILTI tax? One option is to not take the small business deduction in Canada and instead get taxed at a rate of 26.5%. Now, if you ask why anyone would want to do that, it's a good question. Well, the answer is because Canada has what's called an integrated tax system. What this means is when the corporation is paying higher taxes, later when the corporation pays out dividends, those dividends will be taxed at a lower rate in the hands of the shareholders. Another plan could be to transfer ownership of the business to a non-U.S. spouse. If this isn't an option, there are different strategies to restructure your business to help mitigate the GILTI tax. And of course, you could always consider renouncing your U.S. citizenship. Now, not all of the proposed changes are bad. There are some changes which could offer increased benefits. One notable example is the proposed increase to the child tax credit. Currently, for individuals with children under the age of 18, you could receive a $2,000 tax credit for each child, of which $1,400 is refundable. That means if you have no taxes to pay, the IRS will give you up to $1,400 for each of your children. The proposed change is to increase the child tax credit to $3,600 for children aged 0 to 5 and to $3,000 for children aged 6 to 17. And the best part is the entire amount is proposed to be refundable. Now let's turn our attention to the proposed changes to estate taxes. First, a little explanation of what estate taxes are. These are taxes that are paid on the estates that are valued at more than currently $11.7 million. And this amount increases yearly with inflation. And the amount is doubled for married couples. The rate of tax on these estates can be up to 40%. So what are the proposed changes in this area of tax? First, there's the basis step-up at death. This means that when someone dies, the basis in their assets gets bumped up to the current market value. So, for example, if someone bought 1,000 shares in Amazon when it was trading at $5 a share, it would now be worth over $3 million. I mean, I haven't checked the stock price today, but I assume it's close to what it was yesterday. If that person sold their shares today, they'd have to pay a capital gains tax on that $3 million. However, if that person died and their beneficiary sold the same shares, they would pay no tax on this because the basis of these shares gets bumped up to the current market value at the time of death. This regimen discourages the sale of appreciated assets before death, and Biden is proposing to get rid of this basis step-up. There are also rumors that Biden wants to lower the exclusion amount from the current $11.7 million. As I mentioned, any estate worth less than the exclusion amount would not be subject to estate taxes. The rumor that Biden wants to lower this threshold would mean that more estates will be forced to pay this tax. Some potential planning ideas would be as follows. You could use a Canadian corporation to hold U.S. investments. You could also give your assets, gift your assets right away up to the current estate and gift tax exclusion amount. The amount are shared. The estate and gift tax exclusion amount are both currently the same, and one pile eats into the other. So you can use that up before they potentially get reduced. And of course, you can also consider renouncing your U.S. citizenship. So everything I spoke up until now is just proposals. The ability for the Biden administration to implement any of this will depend largely on the outcome of the elections in the United States. If you look back at the last major tax overhaul in the United States, the 2017 Tax Cuts and Jobs Act was able to be passed as law in record-setting time, largely due to the fact that the Republicans held the House, the Senate, and the presidency. The Democrats in the United States will hold the presidency starting next year, so it seems, as well as the House. The Senate, however, is still up for grabs. Currently, out of the 100 seats available, the Republicans hold 50 of them, and the Democrats hold 48. There is an upcoming election in Georgia which will determine the remaining 2 seats, and if the Democrats win both of them, and there's a tie in the Senate, the tie will go to the sitting vice president. So we will be watching the election in Georgia closely, which are set for January 5th of next year. Now, if you believe you will be impacted by any of these proposed changes, please feel free to reach out to myself or your Zeifmans advisor, who will be happy to help you plan for these uncertain times. That concludes my presentation. Thank you very much for listening. I'd now like to turn to some of the questions which have been asked over the course of this webinar.
Perfect. So let's begin our Q&A session. Again, if you have any questions, please feel free to drop them in the Q&A section, and we will try to answer as many as we can. If not, we will follow up directly with you afterwards. So let's go to Chaim first. So how does an employee's presence in the U.S. create PE, or a PE, I should say?
Okay, so that's a good question. So if you have an employee who habitually exercises the authority to conclude contracts on behalf of the corporation in the U.S., that can create a PE. Also, if you have an employee that performs services while in the U.S. for an aggregate of 183 days or more in a given 12-month period, that can also create PE. So there are different ways that an employee could create a permanent establishment in the U.S. for your corporation, but those are two main options.
Perfect. And then let's change gears and go to Brian. How does a CTB election impact an entity's Canadian tax obligations?
Sure. It's a very good question. Well, first, let's think about what they have to do in the U.S. first. So the check-the-box entity, which is really the Canadian partnership, as they elected to be treated as a corporation for U.S. purposes, has to file a U.S. corporate return to report all their rental income and loss. From there, any tax paid to the IRS will kind of flow up through to the Canadian partnership, which flows up through to the ultimate investors so they can take that foreign tax credit. The Canadian partnership has to file a Canadian return as well, obviously as a partnership, to report their rental income or loss from the U.S. property as well.
Perfect. And this question is for you, Kobi. So this is an example question. My employee enters the U.S. regularly to solicit business. While in the U.S., my employee works from our affiliate's office in New York City. Does my company have a PE? Do I need to remit payroll tax? Does my employee have to file an individual tax return? And maybe, Chaim, you can also chime in on this question as well.
Yeah, Chaim, would you like to start off on that?
Chaim?
So, to start off on that, yes, it can create a PE for the company. And then in terms of remitting payroll tax, if the employee is working out of the affiliate's office in New York City and is ultimately being paid by the New York City affiliate office, then technically the affiliate should be paying the payroll tax on that. But it really depends on how the structure is. But basically it can create a PE for the Canadian corporation. And then regarding the employee having to file an individual tax return, I'll shift that over to Kobi.
Kobi?
Sorry. What was this part you were shifting? I apologize.
Oh my gosh, let me try that again. If someone was paying, I guess, their individual tax, is that correct, Chaim? What would be your piece of advice?
Yeah. In other words, Kobi, if there is a PE in the U.S. for the corporation, right, will that individual have to file a U.S. tax return?
Well, it depends largely on whether or not they're working in the United States. So first of all, if they're a U.S. citizen, of course, all U.S. citizens have to file U.S. tax returns. If the U.S. citizen is working for that U.S. corporation in Canada, then they likely will not have to. I mean, it depends. Also, if sometimes we see individuals working from Canada for U.S. corporations, and they're receiving tax withheld, and taxes being withheld to the IRS. This is a mistake. Which shouldn't have. Really, there should be payroll being processed through Canada and remittance being made to the CRA. In which case, you would want to file a U.S. tax return in order to get back that withholding. So it really depends on a lot of factors. But most importantly, you'd want to see where the person is actually physically located when they're doing their job.
Great. Thank you, Kobi. And Brian, this question is for you. If you invest in a startup company in the U.S., what are the implications?
That's a good question, Kelly. A lot of people tend to shy away from investing in anything in the U.S. just because it's sort of an unknown territory and they don't want to start dealing with compliance obligations. But if you invest into a startup, it really depends on the sort of the legal entity structure surrounding that startup. So if the startup is a corporation and you're a shareholder in that corporation, so you invest money as a shareholder, the U.S. tax is actually relatively straightforward. There's going to be tax withheld on any dividends you receive as distributions from that startup. So you actually don't have to file any tax returns. There's going to be withholding tax of 15%, assuming you file the right forms with the startup, so they know to withhold that preferential rate of 15%, or it could be as low as 5% if you own, I think it's more than 10% in that startup. So if you're a heavy investor, there's going to be 5% of tax withheld, otherwise 15% of tax withheld, and you can certainly take a foreign tax credit for those withholdings. Now, if you invest in a startup through a partnership, it works a little bit differently. It's a little bit more involved, I'd say. If the startup's a partnership, they're going to issue you a tax slip called the Schedule K-1, and you're actually going to have to file a U.S. tax return to report any, I think Chaim touched on this, effectively connected income to you distributed by the partnership. So, for example, if the partnership distributes any business income to you or allocates any business income to you, you're going to have to file a U.S. non-resident tax return and apply for a U.S. tax ID number if you don't have one already. So, two options, really, corporate, through a corporation or through a partnership. Those are some of the common structures and their implications.
Perfect. And this question is for you, Kobi. How does transferring ownership of business to a non-U.S. spouse relieve GILTI? What other business structures can be implemented to reduce or eliminate GILTI? Kobi?
Sorry about that. Yeah, so to answer the first question, transferring ownership of the business to a non-U.S. spouse will relieve you from GILTI simply because once the business is no longer owned by a U.S. individual and it's owned by a non-U.S. person, that business would obviously no longer be subject to GILTI because if you're not a U.S. citizen, you're not subject to U.S. tax law. And GILTI is the U.S. tax law, which applies only to U.S. citizens or U.S. residents. So that's how it would work. To answer the second question, with regards to business structures that can be implemented, really, one strategy we've seen being used is implementing something called the ULC, an unlimited liability corporation. In Canada, you can set up these corporations, and what they do, they provide for limited liability protection, but from the viewpoint of the United States, they're seen as pass-through entities. So in Canada, they're treated as corporations. From the U.S., they're treated as pass-through entities. So any income earned in the corporation from the U.S. perspective is treated as being earned directly by the shareholders. So in that case, since there's no corporation, there wouldn't be any GILTI because GILTI only applies to the corporations, foreign corporations. However, there are some planning strategies that need to go into place if you wanted to use this strategy because of the flow-through nature of a ULC. You don't want to have a year where you're picking up the corporation's income entirely, and treating that as taxable in the United States, and you don't have the appropriate amount of foreign tax credits to offset that tax in the United States. But nonetheless, the ULC is a common one that we use.
Amazing. Thank you so much. And let's just move to everyone's closing thoughts. And if we missed your questions, we will be following up with you shortly after this presentation to answer them directly. So with that, let's start with in order of who presented. So Chaim, what are your closing thoughts and any advice that you wish to share that maybe you didn't cover in your presentation?
So basically, if you do plan on expanding your business into the U.S., I would really recommend you contacting us at Zeifmans to basically help you set up, the proper structure because it can get pretty complex and there can be a lot of compliance involved with it, especially from a state tax and sales and use tax perspective. So I would really recommend, contacting us prior to expanding. But if you've already expanded your business, no worries. You could still contact us anyways, and we'll be glad to guide you along the way.
And Brian, is there anything that you wish to share regarding real estate that perhaps that's maybe something you really want to hit home with our listeners today?
Yeah, absolutely. Just want to emphasize that investing in U.S. real estate, while there are U.S. tax implications, it's certainly not prohibitive. So, if you have an opportunity available to you and you have a bunch of investors, there's definitely no reason to shy away. There's definitely workarounds to some of the hurdles I discussed. And, certainly here at Zeifmans and in the cross-border team here, we're definitely here to advise you every step of the way.
Perfect. And finally, Kobi, any words of wisdom that you wish to share, any things that we should be looking out for in Biden's tax plan in 2021?
Well, yeah. So as I already said, these proposals, they're all just that. They're just proposals, and I mean it's important to be aware of them. So if any of them would impact you, you would be able to make plans and put those plans into place so that you wouldn't be heavily impacted by them. And it's so we're looking forward to the elections in Georgia and to see how those turn out. If the Democrats win both seats, then there's obviously a greater likelihood that these proposals will come to fruition. But even still, there is a legislative process. There's a lot of back and forth before these laws can be passed as law. So just because these are being proposed doesn't mean any or all of them would be will come out as law at the end of the day. So if you are concerned, of course, as everyone's mentioned, reach out to us. We're here to help. That's what we're here for. Anytime, day or night. Well, maybe not night, but anytime. and that's all. Thank you very much.
Perfect. And again, if we haven't hit it home enough, if you'd like to contact Zeifmans, our contact details are found on the lower center of your screen. Again, please feel free to reach out at any time. Our U.S. Tax Team and our entire Zeifmans team on a whole is here to help you. So thank you, everyone, for joining us today. Your time is much appreciated. Enjoy the rest of your day. Thank you.